You ever walked into a supermarket and paid $10 for an apple? Chances, probably not. Because you know $10 for an apple is probably too expensive. Well, the same thing about the stock market. If you walk into a stock market and you pay $10 for an apple, it's a very questionable decision. So hence why, you want to have valuation methods. If I go into a supermarket and I pay $10, I know I'm overpaying and I probably shouldn't do that. So the same thing on the stock market. If you're buying a stock and you're overpaying and you know you shouldn't do it, you probably shouldn't do it. But the thing is, the markets have funny ways of working in our minds, and it's even worse when we don't know the value of everything, right? So it's like walking in the supermarket, and if I don't know the value of an apple, I will pay $10 for an apple, particularly if everyone's saying these apples are amazing. But probably no amazing apple is worth $10. Though find me one if you can. I might pay $10 for an apple if you can find a really amazing one. But chances are, in most cases, it's not. And the thing is, in the stock market, it happens all the time. We have these $10 apples being sold and people just buy them up. And eventually the price falls and they end up losing a lot of money. And it's a bit of a tragedy in some cases. So hence why this is an important skill to have. You want to look at a company and you want to decide how much it's worth, right? And no matter what you do, knowing what the value of something is always really important. Particularly if you're looking at investments, if you're buying a house or you're buying a car, knowing the value of it is so important, and you save money out of it. You don't end up putting yourself in a situation where you're taking on much more risk than you need to, because if you pay too much, the risk of getting a return lowers substantially. So hence why these valuation methods. So here I've given you some very basic details for this hypothetical company. Let's assume it's a lemonade stand, right? So for this lemonade stand, we sell $1,000 of lemonade a year. And the assets of this lemonade stand, the stand and the cups and the chair, is worth $200. And for liabilities, we have $50 owing. So somehow this lemonade stand borrowed $50 because maybe it needed some cash flow, it needed to buy some more inventory. But either way, this $50 has to be returned. So if you invest in any company that has liabilities, you need to make sure this company can return those liabilities eventually. And out of those that $1,000 revenue, $100 is our profit. So meaning there's about $900 in expenses. That could be inventory like the lemons, the sugar, and whatnot, and taxes, and of course. And that's amounted to about $900. Hence, leaving us with $100. We can do whatever we want. We can return this $100 back to investors as dividends, or we can use it to expand the business, right? So now that we've got these basic figures, we can start looking at the models, and the most important figure right now would probably be the net profit, because basically it gives us an idea of what things are worth in a sense. So with $100 net profit, and we put into a discount cash flow model, we can start to work out what we might pay to have this, business operating, because it's no point having this business operating if it's not going to generate the return that you as an investor expect. So with the discounted cash flow model, you can look this up online. There's plenty of more other details online. But for here, I'll just keep it nice and basic. The three components of a cash flow model is PV, the present value, which is what everything's worth today. The future value, which is what the values are of the future, and then we have a discounted rate, which is basically the rate of return that you expect from your investment. So let's assume for this lemonade stand that it currently generates no revenue, but in a year's time it will generate revenue of $1,000 and a net profit of $100. We'll take that $100 and we'll discount it, because $100 in a year's time is time, right? And time is money. It's an opportunity cost. With that year, you could have went and put your money somewhere else. So the reason you put your money here is because you want a return of 10% and you know you might get it. So here we've got $100 discounted by 10%, that's $90.90, and for year 2 that's discounted by 10% twice. That gives us $82.64, and for 3 years discount by 3 times, that's $75.13, and it gives us an overall value of $248.67. If we know we're operating a lemonade stand for 3 years, then basically we're going to go any investment cost of less than $248 we're going to do, because if we know at $248 after 3 years, we would have known that we would have got 10% per year for those 3 years, which is what you want as an investor. You want to make sure that your capital invested brings in the rate of return that you want, and hence why we've got this kind of model. Now this model is very popular with institutions, hence why they teach it at university courses or finance courses, because it's the one certain way where we can put numbers together and we can work out something that we might feel comfortable with. Hence why this is probably the most comprehensive way of working out things. But the problem is we're looking at future values, which is the future, and in the future we cannot be certain anything is going to happen the way we think it is. It is all predictions, hence why you have all these analysts coming out and they have all these wild guesses about what future revenue will be, what future profits will be, and sometimes a lot of them are really wrong. Though generally they come to a very good consensus right in the middle, where you've got extremes on both ends, but the middle tends to be kind of correct. So that's kind of it is helpful in some sense, but take it with a grain of salt sometimes. And this is a discounted cash flow model, right? Usually usually companies run forever, so we kind of might take a different stance. But we're just assuming for the next 3 years here, then we'll get this kind of figure here. We could do it for 10 years, 100 years, probably 10 years is probably a good way to go. Then if this is like a worthy kind of business you would want to invest into. And then from there you can, work out if it's worth your, return. Usual cases, company will have growth or they'll have inconsistencies, and hence why why predictions are kind of difficult with these kind of things. And then we'll basically take this $100 figure as well, and then we've got a price to earnings kind of way of doing things. So price to earnings, usually certain industries will have certain price to earning ratios. Say like the car industry had something around 10. Utilities like power had like a thing of like 20 to 30. Just depending on the risks and how strong the competitive moat is. And then basically from there you can kind of work something out, because you're working on the risk, the consistency, the competitive advantage, and you've somehow just come to a figure that you feel is going to guarantee you a safe return for the risk you're taking for the next 10 years or so, or 20 years, or however many years you prefer, right? So and say like cars, usual case was P of 10. So if we had a profit of $100, we would times that by 10, and basically we would pay $1,000 for that company if it was earning $100. And at a P ratio of 15 would pay $1,500, right? So sometimes you can just take a very basic approach and go, what kind of P ratio is this industry currently paying? And hence I can project it onto another company in the same industry, and I'll go, that's the easy way to compare the same companies, right? Sometimes you have like medical companies or companies, and they all have different ratios. So it's a matter of finding companies that you like and working out those ratios from there. And that's one way. Another way is working out with assets. So here we looked at a situation where we had assets of $200 and liabilities of $50. Remember, you always have to pay back that $50, so you want to make sure you have enough money for that. And if you have $200 minus that $50, you've got $150, right? So here we're giving an asset value of $150, right? And for that, we'd look at the kind of method we looked at before, and we'll go like, how do we get $1,000 here and then end up with $150? So sometimes we end up with businesses that have certain assets and certain values that might seem very low in value, but it's because those assets generate a significant amount of value in terms of its revenues. And most cases the market will look at the amount of revenue, hence the cash flows that this company generates, and it's going to give us a more reliable situation, because having assets is one thing, but it's a matter of how much. If I put my money in this company today, how much do I expect to get in return? And if you could buy this company for $150, you would do it all day, but the chances are people won't let you do that, because they're going to see this company as a much more valuable company based on its net profits. And another way of looking at assets is also how much would it cost to build this company today. So we could look at, say, a company that took 10 years of our research and development, and then finally today it gets, it gets to launch its products, and hence we might value it based on the amount of time it's taken and also the amount of money put into research and development. And usually, say like companies like biopharmaceuticals will have that type of approach based on the years they put in and how much their future products might be worth as well. So in a sense, it's kind of like looking at the asset value of a company. And then we have a sales multiple. So this is really common among growth companies. So growth companies that are growing really quick usually have very high sales multiples. In the past, it used to be like 5 or so, but these days it's like 10. But now it's even moved more, particularly now we're looking at tech. Sometimes the bigger the margins these companies have, the more people are willing to boost their sales multiples, because based on the growth of those revenues, they're expecting that eventually when they start making profits, if this company isn't making a profit, eventually it's going to make really good profits. So hence why we have a sales multiple. If we have a company that's at a earning revenue of like $1,000 and we do a sales multiple of 5, then we end up $5,000 as the price would pay. But we only use sales multiples for growth companies because it doesn't make sense to use it for like a company that's not growing, because you're really overpaying, right? So if we look at this company here, and it's got a revenue of $1,000, and say those profits are not growing, and we pay $5,000 for it, it might seem very, very excessive. But if I was saying this company's revenues were growing at 50%, so today it's 1,000, tomorrow it's 1,500, then it's suddenly become an extremely valuable company because it's earning more money in the future, right? So hence why someone will pay a sales multiple, because they believe the future is much, much more brighter and they're paying for that value. So if we look at sales multiples, it's usually for growth companies. If we look at price to earnings, it's usually for companies that are mainly focused on generating profits. And then if we look at asset values, it's more the case of companies who have either been really undervalued based on their assets or the amount of time and money they put into something. And then hence that's how we can look at our different valuations, right? So yeah, like discounted cash flow model is like predicting the future first, and then from there we can kind of get a better understanding if the future earnings will be good or bad, and then we can use our PE to basically go, are the future earnings going to be consistent? Are they going to keep up with inflation? And If they are, then we would give them, based on our perception, we sometimes give them higher multiples, sometimes we give them lower multiples. So it just depends on the industry itself as well. Say like the car industry, they get a lower sales multiple, price to earnings multiple, because their sales change year to year. Whereas for a utility like power companies, they're very consistent about the sales they do, the net profits they do. Hence why we can give them a higher price to earnings, because the risk is lower. So yeah, like we look at these four approaches, and I'll say they're more or less what you need. I wouldn't say you need that much more, because the market doesn't really try to do it that much more. Like if I was to condense it to two main ones, I'd just say price to earnings and sales multiples. Price to earnings for your companies earning profits, and sales multiples for your growth companies. And from there, you'd get some pretty decent valuation methods that you don't actually have to work, over. You don't need to overthink it in a sense. But of course, you need to know what the industry's selling at, right? You don't want to overpay for something that the industry's not valuing at that price. Of course, there's differences. So like you have, say, Ford and GM being valued at a certain price, and you have Tesla being valued at a different price. It's quite different, right? Tesla's being valued at a sales multiple because it's a growth company, whereas you have, say, like Ford and GM, they're being valued at a PE ratio situation because they're not really growing, but they're producing profits. So we have car companies that are, in the same area, right? But we have one based on growth, and we have another based on price to earnings. And that's sometimes, the valuation methods are different, right? Because if we value Tesla on a price to earning ratio, those numbers will be through the roof, right? Not, it would basically be, it wouldn't make sense. So hence why we use the sales multiple to get the valuation rather than the price to earnings. And from there, basically, yeah, like you can look at most things and you can make a very simple, quick calculation, and you'd get a very good idea. Of course, you need to know what sales multiple you're paying, if you pay a 5 for a sales multiple for other companies that's, growing but not growing as quick, then, you don't want to, you want to look at the growth, you want to look at the margins, and from there you kind of get a very good idea of what sales multiples you want. Usual case, for really good companies, you would use the 10, because if they have good margins and good growth. But these days I'm seeing much more. Like we look at a company that, say like Snowball, right? They're well past sales multiple of 50 or so, and that just seems ludicrous. But people are willing to pay that because the growth rate is extremely high. But yeah, that's the one thing, right? If your growth rate is high, you think your, revenues will actually grow so fast that eventually that number won't seem so high in terms of sales multiples. And the same thing with your PE. Sometimes companies will have a high PE is because their net profits are growing really quick, and eventually a few years from afterwards, the earnings PE ratio won't seem so high. So hence why I've got these methods. They're not terribly complicated, but they're very, very useful and things that you should know. Again, I've kept it basic, but you can look on Google and you can find more of this information. I hope that has helped. If you've got any questions, just post below. Until then, good luck investing. If you want me to make any other type of videos, just post below, and I always welcome those ideas. Until then, goodbye everyone.